All right, future CPAs of the Philippines. If you think financial statements are just boring numbers, think again. The real drama, the plot twists, they're hidden in the inventory notes. Mastering these disclosures isn't just about acing the LECPA. It's about learning to read between the lines of a company's story. So today, we're going to crack the code on IAS 2. Let's get right into it.
So what are we really looking for here? Seriously, forget all that boring compliance talk. I want you to think of this as your first lesson in financial forensics. Yeah, you heard me. These inventory notes, they're not just some footnote. They are a wide-open window into a company's soul. Are they actually selling their stuff? Is their production line a total mess? All the juicy answers are right there, and we're about to go find them.
Okay, but before we put on our detective hats, we got to learn the number one law of the land. And every good detective knows the rules, right? When it comes to inventory, under both IFRS and our very own PFRS, there is one single golden rule you cannot break. Everything, and I mean everything we're about to talk about, is built on this one core idea.
And here it is. Seriously, screenshot this, tattoo it on your brain, whatever you got to do. Inventories must always be measured at the lower of two things: cost and net realizable value, or NRV. That's it. It's a simple but powerful rule. Why? Well, it's all about keeping companies honest. It stops them from pretending their assets are worth more than they really are. You just can't say your inventory is worth $1 million if you can only sell it for half that. It's a mandatory reality check.
So, let's talk about this NRV thing. What even is it? Okay, the official definition sounds super complicated, like a total mouthful. But don't worry about that. Just think of it like this. It's the price you think you can sell something for, minus any money you still need to spend to finish it, and minus any cost to actually make the sale happen, like delivery or commissions. So at the end of the day, NRV is just the cash you actually expect to walk away with. It's your net gain.
Let's make it even simpler. Look at it this way. Cost is the past. It's what you already paid. NRV is the future. It's what you hope to get. The golden rule just forces you to be realistic, to be a little bit pessimistic even. You always have to report the lower number. That's the whole game. It's all about playing it safe and not getting ahead of yourself.
All right, we've totally nailed the golden rule. Now for the main event, telling the whole world what you're doing. This is the official disclosure checklist, straight from IAS 2. And let me be super clear, this is not a list of nice ideas or suggestions. These are mandatory. You have to do them. For your LECPA prep, this section is pure gold. Pay attention.
Okay, first up on the checklist, you got to show your cards. You need to be totally transparent about your accounting policies. Are you a FIFO company or are you using weighted average? You have to spell it out. Then, you need to state the total carrying amount of your inventories. That's just a fancy term for the final number that actually goes on the balance sheet. After you've applied that whole lower of cost or NRV rule. But wait, you can't just slap one big number on there. Nope, you have to break it down.
And this breakdown is where the real detective work begins. Check out these common classifications. If you're looking at a manufacturer, you'll see a story unfold. Raw materials become work in progress, which then become finished goods. A smart analyst can look at those numbers and see if there's a problem, like maybe too much stuff is stuck in the work in progress stage. That's a bottleneck. But a retail store, they'll mostly just have one category, merchandise. So right away, you know what kind of business you're dealing with. See? It's all about the story.
We're not done yet. The checklist keeps going. Obviously, you have to disclose your cost of goods sold. But now we get to the really juicy part of the story. You have to tell everyone about any write-downs. That's the L you take, the loss you record, when your NRV suddenly drops below your cost. But here's the kicker, and this is critical. You also have to disclose any reversals of those write-downs. Honestly, this one rule is a total game changer. Getting this separates the students from the real pros.
So yeah, let's zoom right in on that juicy part. Mastering write-downs and reversals? This is your power move for the LECPA. For real. Why? Because our standard here, PFRS, which follows the international rules, handles this in a totally different way than, say, US GAAP. And if you understand this difference, trust me, you're going to look like an absolute genius.
And look at this, it's straight from the source. The standard literally says that when things get better, you have to reverse the write-down. This isn't a maybe or a you could, it's a you must. It's a direct command. The whole point is to make the financial statements tell you what's happening right now, to reflect the current economic reality, not just some bad news from last year.
And this right here is the great divide. Okay, Picture this. A local company has last year's phone model. It cost them 20,000 pesos. A new model comes out, so the value of the old one drops to 15,000. They have to take a 5,000 peso loss, a write-down. But then, plot twist, the new phone from their competitor is a total flop, it has major bugs. Suddenly, everyone wants the old, reliable phone again, and its value shoots back up. Under our rules, PFRS, that company gets to reverse the 5,000 peso loss, which boosts their profit. It's a comeback story. But under US GAAP, nope, sorry, that loss is permanent. That is a huge difference in the company's final profit number.
So, let's walk through that comeback story step by step. First, things go bad. The NRV drops, and you have to recognize an expense, which hurts your profit. Bummer. But then, the market totally turns around. Under PFRS, you get to reverse that loss. And here's the best part, the how. That reversal isn't just some random line item called other income. No, it directly attacks and reduces your cost of goods sold for that period. And when your COGS goes down, your gross profit goes up. It's a direct boost to your bottom line.
Okay. Whew, that was a lot, I know. A real deep dive. But now it's time to pull it all together. We've followed the clues, we've cracked the case. So, let's lock in everything we've learned with the ultimate study hack. Get your phones out, get ready to screenshot the next slide. This is your cheat sheet for the LCPA.
All right, let's do this. Rapid fire review. Number 1, the golden rule, always the lower of cost or NRV. 2, what's NRV? It's the selling price minus the cost of finish and sell. Basically, what you pocket. 3, you have to disclose everything, your policies, your total carrying amounts, and all the different classifications. 4, you must disclose write-downs, reversals, and you got to explain why you had a reversal. 5, the big one, PFRS says you have to reverse, US GAAP says no way. And finally, number 6, a reversal is awesome because it lowers your cost of goods sold. Boom, you got this. That's the whole key.
And that brings us to the end. Look, this was never just about memorizing rules for an exam. You've just learned how to be a financial detective. Now, when you see a company with a history of write-downs, you'll see a red flag. But when you see a reversal, you might just be spotting a company on the verge of a brilliant comeback. This knowledge is your new superpower. So the real question isn't if you'll pass the exam, it's how are you going to use this power? That's it for this one. Now go out there and crush it. See you next time.